Good afternoon, traders and investors. Will back here with another one, coming to with a Sunday video, guys. And it's that time of the week again where we go over the top 5 options plays for the upcoming week. Hopefully all of you had a very nice weekend, and hopefully you are all very well rested from the holiday period and ready to lock it in for the month of January. Now, keep in mind, guys, all of these options plays are going to be for selling options, more specifically for selling put options as part of the larger wheel strategy that we like to run on the channel. Now, this is a very easy strategy to run, whether you're a beginner, intermediate, or even advanced investor, and allows us to collect a lot of premium in a slightly risk-averse way. Now, it's a strategy that I've been running on the channel publicly for now 2 years, and the performance over the course of the last year, wrapping it up with the New Year week, guys, 63%. Not too bad at all. That is roughly 3 times the performance of the S&P 500, which closed the year roughly around 22-23%. Very good year for us. And last year, when we were also running this one on the channel, guys, this is a video of me 1 year ago recapping last year where we had 73%, which was also good for about 2.5 times the S&P's performance. So the strategy is very consistent and very profitable if you respect the rules. So in today's video, we are going to be going over a few things together. Number one, of course, we're going to be going over the expectations for the week. What do we have in terms of technical analysis on the SPY and the QQQ? How are the markets currently standing right now? And also, do we have any macro news events that could possibly throw some volatility in the mix over the course of this week of trading? So that'll be number one. Number two, we're going to be going over the strategy rules that I like to look for when shopping to write put options. And then number three, of course, get into the juicy stuff, the top 5 options plays of the week and bonus plays as well. All in all, guys, even though it's a top 5 video, I will literally be throwing at you 20 to 25 different trade ideas. So there's definitely going to be enough for everybody out there. So let's get right into it, shall we? So in terms of the expectations for the week, guys, well, in terms of the technical analysis, the SPY and the QQQ admittedly are not looking too bad. We still do have the weekly uptrends, even though it's been a fairly bumpy period, especially since the Jerome Powell FOMC decision on December the 18th. That being said, we have not lost the weekly uptrends, and the daily are finding support on the SPY, 585 down to 576, seems to have found a local bottom, the fear local bottom, guys. Why do I say that? Because the markets right now are indeed fearful. We've been trapped in the fear zone now for roughly about a week of time, and several indicators in terms of momentum, stock price strength, stock price breadth as well, which we know has been a problem, are at extreme fear reads. Keep in mind, I like to go over these as well. Percentage of stocks above the 20-day moving average. Now on Friday, we did have a bounce, but I was saying in the last video last week, guys, when we get down into these lower 30 to low 20% range of percentage of stocks above the 20-day, usually it's a good buying opportunity in combination with a lot of fear in the market, right? So we are looking to go shopping and start to buy the dips, but we have to be patient with it, not trying to blow the cash all at once. Percentage of stocks above their 50-day as well, those are also quite low at around 38%. You can see that when the markets dip down into these ranges, yes, they can go lower, but it is an opportunity to at least start to buy the dips somewhat aggressively, right? And percentage of stocks above their 200-day, the longer day moving average, also quite low at around 53%, some of the lowest periods in time through the year of 2024. So definitely can have some buy the dip opportunities, guys. However, we need to keep in mind the month of January is going to be very volatile. So even though the technical analysis doesn't look too bad, we have the weekly uptrends, we know that the month of January is going to be fairly volatile. Number one, we have Trump's inauguration on January 20th. Thereafter, the week after that, we have all of the big tech earnings. And additionally, at the end of January, we get a potential Federal Reserve pause in terms of interest rates. So all of that combined, guys, could lead us to have a smooth early portion of January, but maybe a bumpy little end to the month of January as well. Couple that with our seasonality too. Here's the seasonality for the month of January. Midpoint of January seems to be okay with the January effect coming into play, but then towards the end of the month of January, guys, you see it does get a little bit bumpy before having a decent start to the month of February after that. Once we get through all of the volatility catalysts, the big tech earnings, Jerome Powell, Trump coming into office and outlaying a few of his initial policies, all of that will be at the end of the month of January. But as of right now, we may have a nice week in the markets, so it could be a decent opportunity to farm some premium. I remain cautiously optimistic on the markets, guys, but I'm not going to be biting off more than I can chew. I'm still being patient, letting the market come to me and not chasing the market to the upside. I want to be playing names that are on dips right now in decent buying locations and solid companies that also have very favorable valuations. So that is your outlook for the week. Should be fairly okay, but keep in mind in terms of macroeconomics, guys, it starts to get a little bit volatile come the Tuesday session. Tuesday, we get ISM services PMI, we get the JOLTS jobs openings, which the Fed looks at a lot. On the Wednesday session, we get ADP employment, that is public employment change. And in the year of 2025, guys, it's all going to be about two things. Number one, inflation. Is it coming back or not? So we need to pay special attention to all of the inflation reports, such as this service PMI, the CPI, of course, and then, of course, the a few other metrics that are going to come in later on in the month, such as your PCE and stuff like that. So on the Thursday session, nothing there. But then on the Friday session, you can see a very big one, non-farm payrolls. So this week can be a little bit bumpy, especially if some of these jobs reports come in fairly weaker than expected. Well, the 1 day's worth of bounce on the Friday session may simply get challenged later on in the week as the bears try to go for the daily downtrend continuation. Good thing for us, we have a lot of support below us, and good thing for us, we also still have a lot of room before we forfeit these weekly higher lows. So that is why I'll be going a little bit light this week and waiting for these potential volatility events to send us with some big red candles to the downside, and that is when I want to go shopping. So still cautiously optimistic in these markets, but I'm going to be very calculated and cautious in the positions that I choose to run. So that being said, that is the expectation for the week, guys. So now moving into the part number 2, which is going to be a few of the strategy rules. Now, if you guys have already seen these strategy rules, feel free to skip ahead to the top 5 options plays down below. But right now I'll be doing a quick recap of how exactly I like to run the put wheel strategy. I'll be going through these rules very, very quickly. I have a 30-minute video explaining the strategy more in detail, and I'll leave that video down below in a link to the description. In the description, rather. The free video on my YouTube channel. I filmed it about a year ago, and it outlays a lot more of these strategy rules in a lot more detail than I'm about to go in right now. So, number 1, the put wheel. What exactly is it? Well, when we're looking to sell puts to open, guys, we're essentially looking to create a buy limit order that pays us. Let's say we wanted to buy Uber stock all the way down here. There's 2 ways of doing it, right? You can either set a buy limit order at $61 or $60, but if the market just rallies, your order never gets filled, you never make any money. That is where short puts come into play. They act as buy limit orders that pay us if they do not get filled, or even if they do get filled. So keep in mind, guys, if I want to buy Uber down here, let's say it's 61, there's, and I want to use short puts, we can go in the options chain right here, and you can see that, well, 61, there's not enough premium. Let's say for purpose of example, I'll go with the 62s and it'll make sense a little bit. Let's say I wanted to buy Uber at 62. You'll see that we get $26 in premium just for putting a buy limit order in the market. If by the end of next Friday, the stock price of Uber ends above 62, we just get to collect all of this $26 in our pocket and nothing else happens. If the stock price ends below 62, we have to buy the shares there like we were planning to do anyways. And as a result, we do get this $26 in credit, and we get to apply that against our average cost. This will reduce the average cost of 100 shares by 26 cents per share. Very easy way to get into a stock at a slight discount using the put credit premium as your discount. So what we want to do, guys, is rule number 1, we want to build a watch list and filter by red. Every single Monday and Tuesday morning, I will go on this watch list that I've built, filter the companies by red, and I'm only interested in the ones that are red. Why? Well, when we go through these rules, it'll make a lot more sense. But we want to always be filtering by red, not chasing the market to the upside. We want to be playing companies that are down on that day. Rule number 1, high quality and high conviction companies only, guys. Why? Well, because there's always a risk of being assigned. And if you get assigned, if you have to buy 100 shares of a stock, it may as well be a stock that you have very high conviction in, and it may as well be a stock that's very high quality. The last thing you want to do is get trapped in a stock that you do not have high conviction in and a stock that is not high quality. Then you have to open your account every single day, see the loss, and wonder what the heck you were doing in the position in the first place. So high quality companies only, guys. This is rule number 1 for a reason. This is where most people get it wrong, and this is where most people accumulate some losses that they could have very well easily avoided. Number 2, we want to be looking at stocks that are in monthly uptrends or in long-term ranges. A monthly uptrend can look something like the SPY, right? Something like a Microsoft, something like an Apple, or a long-term range. A long-term range, very simply, is like Microsoft is in right now. This long-term range that's been there for about a year, right? We've been trapped in this long-term range for a year. I like to play the lower end of the support level of that range. Usually a very high probability setup when we do take those plays. So all the plays you'll see that I take are always usually in a monthly uptrend or a long-term range. Number 3, company needs to not have any earnings this week. Now, this is not going to be a problem, guys, because we don't really have any earnings on any big companies this week, but you do want to avoid playing earnings or playing short puts on companies that have earnings. You know it better than me, guys. Even though a company can have very good earnings, they can go down 5, 10, 15, 20%. So if you want to avoid any outsized losses and any volatility in relation to earnings, just do not play any short puts on companies that have earnings this week. It is just not worth it, guys. Number 4, we want to be writing puts on companies that are in support areas or areas of a breakout retest. I'll show you the two types of trades. An area of support, like we showed on Microsoft, is a long-standing area of support. Months and months and months of support. Usually when the stock comes back down into it, this is usually a very good area to be writing short puts. What is a breakout retest trade? That is otherwise known as a trend continuation trade. Watch, you get the breakout of the long-term resistance range, you get the breakout, you get the retest of this range, and then the run. This retest area, usually a very high probability trade. It is a trend continuation trade. So all of the trades are going to be one of the two, guys, either a big support area or a breakout retest trade. Now, number 5, we want to be looking at looking to shop for companies to write short puts at levels at or lower than the expected move. If you guys don't know what the expected move of a stock is in a given week, you can go to this website right here, barchart.com. It's free. Just type it into Google, whatever stock you want to look at. Bar chart, Nvidia, expected move. You'll come to this page. It gives you the expected move. What is the expected move? It's the probabilities that Wall Street says that can go up or down in a given week. Here you can see SoFi can move up or down 5% from the current price. So when we're looking to write short puts, we always want to be below the lower end of this expected move. Why? Well, because simply if the stock moves down very, very aggressively into the expected move or below the expected move early on in the week, usually it will have a little bit of mean reversion midway through the week and pull us back within the confines of the expected move. So if we can go shopping when the stocks are at the low or at or lower than the expected move, usually it increases our odds of not being assigned. All of these criteria increase our odds of not being assigned. Next point as well, writing on a red or flat day. Well, it stands to argue if we always want to be writing at or lower than the expected move, we're going to need to be picking stocks that are on a red or flat day, right? It serves me no purpose if a stock goes up, if SoFi goes up 5-6% on a Monday morning, well, I'm not going to be able to get any premium down to the lower end of the expected move. I'm just going to be chasing the stock to the upside, and that's not a very good recipe for consistency. So we want to be combining these two things together. Now, before last point here, this is our ROI. We want to be writing between 0.5% and 0.75% in weekly premium. This is our take-home pay, guys, right? So in the 6-7 years that I've been running this strategy consistently, this is the sweet spot between very good ROI and a low risk of assignment. So what do I mean by 0.5 to 0.75%? Very simple, guys. You go on the options chain right here and you want to find 0.5% per week. How do you do that in your head? Very, very quickly. Very simple. Just divide the strike price by 2, and you want to see that on the bid in terms of cent increments here, right? So if we divide 62 by 2, that's 31. So you know that to take this put option, you want to be seeing at least 31 cents on the bid right here. At 26 cents, it's a little bit thin. If we do the math, 0.26 divided by 62, you'll see it is not quite 0.5%, just under. A lot of people like to use delta, but the problem with delta, guys, is if you're looking at Uber or Coca-Cola or Nvidia, a 20 delta and a 30 delta will be different depending on the strike. For a stock like Coca-Cola, a 20-30 delta is not even going to be 1% away from the share price. It's just too close. So an easy way to go through a ton of options chains without looking at delta is using the 0.5% rule. It will encompass the volatility for you. So everything is priced into the 0.5% rule, and you can go through a lot of options chains really, really quickly by just looking at the strike, dividing it by 2 in your head, seeing if there's 30 cents right there. If not, then perfectly fine. You just move on to a next trade, right? So this is the ROI. And of course, guys, I write weekly premium because usually on a per week basis, you get the most amount of ROI. But if you guys want to write 2-week puts, 3-week puts, 4-week puts, 6-week puts, doesn't matter. Just make sure you're getting at least 0.5% per week if you're looking to write those longer dated options. And lastly, you want to set a take profit order at 90% of the contract value. This is just being capital efficient, guys. If we write some of these plays on a Monday or Tuesday session, and by Tuesday afternoon or Wednesday morning, they are 90% profitable, why would you hold the trade until the Friday close? It's just not worth it for that extra little 10%. You'd rather just close the trade, look for a new trade where you can get a full amount of premium and be capital efficient. So this is how to get into a stock. We write short puts. It's like a buy limit order. Then if ever we get assigned, if ever we have to buy the shares, we will look to get out of the trade by selling covered calls. This is a sell limit order above the market. Covered calls, same rules. We want to be looking for 0.5% to 1% in weekly premium, and we want to be writing these covered calls at our assigned strike price. So let's say I get assigned Uber at 62 by Friday. The following week, I'll look to write covered calls at $62 or one strike price higher. The only time you'll see me write one strike price higher, guys, is let's say I get assigned on Uber at 62 on the Friday session because the stock closes at 61. And then the following Monday after that, the stock has good news, gaps up 4 or 5%. That is the only time that you will see me probably write one strike price higher. But I would say 95% of times where I get assigned any stocks, it doesn't happen that often, but when it does, 95% of the time I'm writing at my assigned strike price, guys, and not one strike higher. So that is all the strategy rules. Hopefully you guys enjoyed that. Now let's jump into the juicy stuff, shall we? Let's get into the top 5 options plays. And you'll see that a lot of these are recurring that we've been doing over the last 1 month of time. Why? Because they're all very good companies and they're all still at very nice levels of support. So trade number 1 for the top 5 options is going to be a combination of semiconductor plays. Number 1 of which is AMD. So AMD, the reason that I like this one, guys, you can argue that yes, it is a monthly downtrend. That is true. So it does break one of our rules. However, the reason that I like this one is because the valuation is super cheap right now. The growth is very good. The PEG ratio right now is sitting about at 1.07. That's extremely cheap. You can see the thesis here for AMD. The analyst price targets are all above, and the thesis is the data center expansion through 2025. Look at this EPS ramp the next 3 years, and also look at this revenue ramp too for the next 3 years. They should be doing very good, but they have not been doing very good as of lately. So I do think it's a very good opportunity if you do like this company and you do agree with the thesis to be buying this company at relative lows, close to the 200 weekly EMA as well, which is down to about 115. You can see usually when AMD comes around that 200 weekly moving average, it doesn't happen that often, but usually it does provide us with a very decent buying opportunity for a company that has good growth prospects ahead of it. Now, the expected move for the week is 121.05. So we want to be looking below 121.05 to find any put credit premium. So taking a look right here, let's pull up AMD. And let's go shopping together, see if we can find anything below 121.05, especially with the fact that they've established now a local level of weekly lows. So let's take a look at AMD and look for the 0.5% rule. Well, you guys will see that 120 is offering 0.5%. Half of 120 is 60, so it does provide roughly 0.5%, slightly more than that, and it is below the expected move. However, I want to be getting a little bit more greedy. Why? Well, because the 200 weekly EMA is down at 115, and the larger support level, now that we've blasted through this one to the downside, the larger support level really starts at about 115 down to 100. So I want to be going a little bit lower. That being said, to get lower, guys, you'll see that there's no premium there right now, right? So what we need to see a little bit of a retracement on AMD. If AMD pulls back Monday or Tuesday back down into the 123, 122, even 121, that will free up some very juicy strikes below 120. Think 118, 117, 116. As low as we can get, guys, close as possible to 115, as low as possible while still getting 0.5%. So that is trade number 1. You want to be dynamic with these. These levels are not set in stone. If you have a big decline, it's going to allow you to get some short puts all the way down here, which makes the risk to reward even better. So be dynamic with your strikes. Do not chase the market to the upside. If AMD opens up green, we don't want to start riding up here and chasing the market. If the trade just pulls away and there's no more premium down here, you just move on to the next trade, guys. So that's trade number 1 as part of the semiconductor trade. Trade number 2 for the semiconductor pairs is On Semi, ON Semiconductor, as I like to call it, right? So you'll see that they have a very large area of support. This area of support, guys, has been standing for the last 2 years, almost 3 years worth of time at this point, and the 200 weekly EMA is being challenged as well. And you can see that same thing as AMD, right? Usually, this is COVID, by the way. Usually, in the context of a bull market, it's usually a very good opportunity to go shopping for On Semi when you have a decline close to or at the 200 weekly EMA. Within the confines of this large support range, the expected move for this week is 61.82. So let's go shopping together, see what we can find over there. So I'll give you this one, and then you guys can do the last one on your own, right? So On Semi, you'll see that at 61, which is below the expected move of 61.82, we do have some decent premium here. We have 33 cents, which is almost, well, just slightly above 0.5%, right? But I want to be going a little bit lower because we know semis have had a bounce on the Friday session. In the event we move a little bit lower Monday or Tuesday on Semi, this could possibly free up some premium, 60, 59, or even 58. So these are my preferred strikes for the week. 60 all the way down to 58. I'll be looking for some short puts on a very solid company, which is rounding the corner in terms of cyclicality, right? I'll remind you why On Semi has been weak. They provide a lot of products that go into the manufacturing of PCs, electronic components, and also auto manufacturing components as well. We know those three sectors have been somewhat weak as of recently, but look, they're rounding the corner and now starting to expand 2025 onwards. That is EPS, and this is revenue as well. So we want to be catching these things when they're rounding the corner in terms of their cyclical weakness period, which has been the case for them all throughout 2024. That's why I like this trade. And option number 3 for the semiconductor trade is Micron. Micron, same thing, guys. They've been down a little bit weak because of PC sales, electronic sales, and also auto sales too. The analyst price targets are well above the stock. You can see they're ramping it back up in 25, 26 for EPS, and revenue, same thing as well, right? These were a few transition years, and now we're back on track. So that being said, nice area of support. This is the previous all-time highs from 2020 and 2021, coming back into them right now. And look over here, we also have the 200 weekly EMA at the lower 80s. So I like this area of support. I like the valuation of Micron. We looked at their earnings. They're very, very, very cheap right now, under $90. So that being said, this is one of my favorite semiconductor trades as well. So that being said, the expected move on Micron this week is 87.02. We want to be looking below that, preferably as low as the local bottoms that we just had, right? 85, 84. Let's go shopping on Micron and see what we can find over there. And this is going to wrap it up pretty much for our semiconductor plays. So looking at Micron, taking a look, we want to be finding below 87, right? So taking a look at Micron, you can see that at 87, we have a decent amount of premium, well over 0.5%. We'd be looking for roughly $44, $43 right there on the bid, but now we're getting even better. So you can go all the way down to the 86 is even paying our 0.5%. Now, if Micron comes down Monday or Tuesday, back down into the expected move, think 88, 87s, that's going to free up probably the 85s or even the 84s, which is my preferred strike. So my preferred strikes for the week, guys, even though we don't have the required premium there right now, if we do get a dip, 85 down to roughly 82, that's going to be the range that I want to go shopping for Micron in. We played this one a few weeks ago down here at like the 83s. It went extremely well. And if that trade opens up again, I would not mind playing Micron down there. I wouldn't even mind being assigned at such a cheap valuation for such a solid company in a very big area of support. So that is all 3 semiconductor plays. Hopefully it opens up some ideas. There's obviously a ton more, guys, right? There's like LRCX, which is in a very nice area of support as well. There's possibly even some Qualcomm down below here, 150 down to 140. You get the idea. There's so many semiconductor trades. I just picked my 3 favorite ones. Now, company number 2 is going to be somewhat of a consumer-facing stock, which has gotten hit a little bit hard. This one's been featured on the channel now for the past couple of weeks. Why? Because of the valuation. The valuation at $60 is a 1 peg. That is extremely cheap in terms of this amount of growth through 2027. I'll remind you, Uber is now a very profitable company, and look at the analyst price targets. The midpoint is about $90 for 2025, and look at the EPS. No problem with EPS growth, no problem with revenue growth as well. They've just been hit very hard because of the robo-taxi news from Tesla, from Waymo throughout the month of December. I think the move is overdone. I like the valuation. I like Uber as it has very large network effects as well. And between you and I, for the robo-taxi business to start disrupting Uber, not only in the US, but like internationally, think of all the regulations that these companies are going to need to go through, right? Uber is, probably years and years and years away from being challenged by robo-taxi networks to begin with. If anything, a lot of those robo-taxis will be initially on Uber's network because Uber has the largest network effect in the world for the business that they do, which is ride sharing. That being said, I love this area of support below us here, guys. 61 down to about 55, my preferred zone. Previous all-time high resistance should be newfound support as well. Not looking too bad for Uber, guys, and the valuation is super cheap. They did have a nice pop back into a daily uptrend, but if we give back some of these gains, could be a nice opportunity to go shopping again for Uber in the low 60s. So the expected move is 62.49. Let's go shopping for Uber and see, can we find anything on Uber below 62.49 for the week? So 62s, you'll see 26 cents. Not quite 0.5%, guys. You need to see at least 31 cents, right? I'll remind you, how am I doing these in my head so fast? Very simple. Just divide the strike price by 2. You need to see 0.5% here. I'll show you the math works out, right? 0.31 would be half of 62. You divide it by 62. There you go. There's your 0.5%, right? Anything under, it's not giving enough premium. So Uber does need to have a little bit of a dip for us to get below the expected move, right? Because as of right now, the 63s are paying enough, but that is above the expected move. And we don't want to chase. We want to be waiting for a pullback and then writing down here. So if we do get a pullback, guys, think low 64, 63, even high 62s, Monday or Tuesday after this rally, a little bit of a pullback, right? I will be sitting down here, guys, 60 down to 58. These are my favorite strikes for the week. 61 down to roughly 58. I would not mind playing Uber down there at all. I think it's very decent value. And as a matter of fact, I do have Uber myself. You can see I already am in Uber. We got assigned at 66, and I even fired off some leap call contracts, guys. I have a leap call contract for June 2026 at $60. We're currently up nicely right now. I love this $60 level, guys, and I'll continue to go shopping for Uber down there. So that is trade number 2. Now for trade number 3, we're going to be looking at Elf Beauty, another consumer-facing stock. But Elf Beauty, guys, this is an industry disruptor as a whole. If you don't know what they do, they're a beauty company, but they have no stores whatsoever. It is an online brand, and they're using, their viral social media marketing campaigns whereby they partner with influencers on TikTok and Instagram. They get a lot of views for their products, and they're building a very loyal customer base with a lot of the younger demographic, such as millennials and Gen Z and even younger. And I do think that with this business model, it allows them to go get better margins, and they're offering luxury quality products at a fraction of the price. This is exactly the type of business that I want to invest in when consumers are tight on spending and they're trading down from the luxury brands to something that's more affordable that they can just order online. And the company, since it mostly only does business online, the overhead cost of running the business is a lot cheaper than somebody like an Ulta Beauty or a L'Oreal or an Estee Lauder, that those guys have actual physical stores that they need to pay for, right? So all that being said, Elf Beauty right now at around the 125, the valuation is not that bad, but keep in mind, guys, right? We're coming out of a bottoming area of support. So take a look at these two areas, right? We have an initial support range down here of roughly 121 down to 115, and then you have the very big one, guys, 110 down to 100. So what I want to be looking to do, guys, is when Elf Beauty is on a decline like this, I want to be going as cheap as possible on Elf Beauty and possibly writing some short puts in the 1-teens. Think 115 and lower. That being said, the expected move for the week is 121.56 on Elf Beauty. So let's go shopping. Can we find anything below that expected move on Elf? Preferably in the teens, right? 117, 16, 15. So let's go shopping for some Elf Beauty together, shall we? So moving on to Elf Beauty, we can see that all the way down here. Look, even though the expected move, right? And I didn't get the expected move wrong. The expected move for Elf Beauty is indeed, it's because it has high volatility, is, 119.63. So I forgot to move it. 119.63. So we want to be below that. My bad, guys. I thought something might have been up. So 119. So look how much below we can get further on Elf Beauty. Look, 116 for 65 cents, even the 115s for 60 cents give us 0.5%. So at a first glance, I like this strike a lot. 115, it's a lot below the expected move, and it is within the lower end of the range of support we're trying to target. That being said, if Elf Beauty has a bad Monday and Tuesday, it comes down 122, 121, 120 initially. Well, what do you think is going to happen, guys? We're going to be able to get even better strikes. Think the 112s, 111, 110s. So at a first glance, The ones that I want to go for, guys, is 115 down to 110, as low as we can go while still getting 0.5%. We want to get as deep as possible and start getting into the bigger area of support down here, because if you play this one too close and they lose level and come down into here, right? This is the larger area that we want to be targeting. So we want to get closer and closer to this area as possible. That is trade number 3. Now, trade number 4 is going to be a combination of value plays. 2 of my favorite value plays that have just been somewhat trapped as of recently. The first one is going to be UPS. I've talked about this one a lot on the channel. Why? Because the valuation right now is getting quite attractive. Lower 120s, we're talking about a 1.15 peg now that they're below 128, and the free cash flow yield of 4% is fairly good. And even if we get assigned in this one, guys, we get paid a very handsome 5.27% dividend. Why has UPS been down for the last 2 years? Well, kind of like a lot of the semiconductor trades have been, right? There was a lot of pulled forward demand in 2021 for shipping and high priority fast shipping especially, which gave the company a great boost in terms of net margins and profitability. And you can see, since the consumers have been a little bit tight, less priority shipping and less overall shipping as a whole, because the consumer market has been a little bit tapered back over the last year. But that is all coming to an end. We are rounding the corner. See, big pull forward in demand, normalization of demand, and now back to growth of the business. The business has been doing a very good job of cost cutting and running a leaner ship, leading into this cyclical decline that we've had. And now look, revenue is coming back up for the next couple of years, and EPS is coming back up as well. So rounding the corner in terms of bottoming out of a 2 years of negative cyclicality in the markets. Where are we lining up as well? Prior resistance, which is current support. This is 2017 and 2018, guys, a long time away. And look, the 200 monthly moving average is there as well. So even though it doesn't look good, we are currently forming a nice base of support leading into our prior resistance. So I like UPS down here at the 120 valuation, guys. I think it's a very fair valuation for a very strong company, which should be having a good upside in 2025 and 2026. Look at the monthly MACD. Monthly MACD, 2 years of negative momentum. It's starting to want to curl, right? Starting. So we want to be kind of playing this down below here, because eventually they will start reversing this. It may take some time, but that is what I like about UPS. So that being said, the expected move right now is 121.78 to the downside. So let's go shopping on UPS to find if we can find anything below that expected move, shall we? So we're looking for below 122, let's call it, right? So UPS, you'll see that because this one doesn't have very much volatility, you need to be very close to the strike. As you can see right now, the only place offering not even 0.5% is right here, the 122s. But unfortunately, the 122s is above the expected move. So what you would need to see, guys, is further declines by UPS. Monday or Tuesday red, that would possibly free up my favorite strike of them all, which is the 120 strike. If I can find 60 cents on the 120 strike here, guys, even 55 cents, I'll probably be going for it. So 120, guys, looking for UPS to have some dips. Whenever we get a few red days in a row, starting off a week like this, we can come into possible daily oversold conditions, into big support at my 120, and that is the area that I want to see, but I need to be getting paid decently for it. Right now, there's not enough premium there, so we need to wait for further declines. Stock number 2 in terms of a value play, guys, is going to be Coca-Cola. Coca-Cola, same concept. They have been nothing but red in the last 4 months. It is a monthly breakout and retest area. Where are we retesting? Glad you guys asked. All of the resistance from the previous all-time highs from 2022 and 2023. This is 2.5 years worth of support for the markets. And after all of this decline, guys, I think we're starting to find a local bottom on Coca-Cola. That being said, the expected move all the way down here is 60.95. My preferred strike, guys, is $60. So if Coca-Cola decides to put in one more weekly leg of downside to the bottom end, look, the 200 weekly moving average is right there. Every time in the context of an overall bull market, you have a few times that it does come below, but it does snap back, right? Here is COVID, of course, but in the context of bull markets, usually every time we come very close to the 200 weekly moving average, it does represent a good long-term buying opportunity for such a solid company such as Coca-Cola. That being said, the expected move is 60.95, but you will see, similar to UPS, guys, the volatility on this one is very small. So you need to be very close to the strike price. So Look at $60. There's nothing there. Even at 61, look, we're 61.75, guys. Even the 61s are barely paying 19 cents. We need to see at least 30 cents. So you need to be very close to this one. So I'll be monitoring Coca-Cola this week. If Coca-Cola goes on its last leg down and comes down below here into the $60 range, I'm going to be going for it. I will be going for the $60 strike, trying to get as close as possible to 30 cents on the bid for that one. So that is a pair of value names that have been, unfavorable at least for the last few months, but could be finding a local bottom very, very shortly. And now the last of the top 5 options plays. As I said, guys, even though it's a top 5 video, there's far more than 5 in here, isn't there? So the last one is going to be a pair of fintech plays that I've been loving playing in the last few weeks. The first of which is going to be Square. So Square, look at this pattern, guys. It is literally a nice monthly uptrend right now. And look at the weekly time frame as well. Nice weekly uptrend. This is a breakout. Where do we break out from? 2 years worth of resistance, guys. Breakout, retest of the range, and possibly looking to run right now. So Square, this has been one that I played last week at the 83s. We did a very good job, closed them at a profit in the Discord, and I also showed this one to you publicly on the channel as well. Now, that being said, guys, the expected move on Square, we want to be playing the lows that we hit in the last few weeks, right? We want to be getting as close as possible to 85, as deep as possible into this whole weekly support zone, which runs 86 down about $79, $80. This little pocket right here, the retest zone, this is the pocket that we want to be going for, right? So Square did have a very nice bounce on the Friday session. However, if we do pull back early Monday or Tuesday, it could free up some of these lower strikes. The expected move is 88.86, but Square usually has some good volatility. So let's have a look. Can we find any premium below 88? Excuse me, it wouldn't be a coffee video. It wouldn't be a video without coffee, right? So look at 88, guys. You can see below 88, there is some good premium. $40, not the worst, but the true 0.5% comes here at 53 cents for the 88s. That being said, you guys know the drill. If we do drop Monday or Tuesday, it's going to be bringing us down towards the expected move, and that could free up some of my better strikes, 86 down to 83. That is the sweet spot that I want to be playing on Square. So at a first glance, 86 down to 83, but you need to wait for a little bit of a dip right now, because as of right now, there's only the 88s. 88 is not a bad level. It's just not the perfect level that I'm looking for, which would be closer to 86 to 83, playing the bottom end of these areas that we tapped into after Powell and last week as well, which is also coincidentally the 50-day moving average. So that is play number 1 for fintech, and play number 2, of course, we have to put SoFi in the mix. Now, I actually got assigned some shares of SoFi last week, and I'm perfectly fine with my assignment. We got assigned 100 shares of SoFi at $15. We got about 21 cents input credit premium. And before even getting assigned, I wrote some covered calls on the Friday session very late in the afternoon. Look how much premium I got for a month of time, guys. This is over 2% per week in covered calls. I got assigned on Friday, wrote covered calls right away. I don't even have to think about this position for another month. That being said, the reason I did that is to drop my average cost quickly, because I will be looking at DCA. If we come down to 13, 12, 11, I'm all for it. I will be DCAing, into that pocket. Sorry, guys, live video, right? It's raw. I'm not going to edit that out. So my bad. So moving into it, guys, where is the support level? The support level is right down here. Now, granted, this is not truly respecting one of my rules, right? We have not really established any local areas of support. You can argue that over the last month and a half, we're trying to establish the 15s. You can also argue that we are slightly using this range from back then, guys. But I'm sure no one would be surprised after such a heavy move higher if SoFi can, come down a little bit further, 14, 13. So we have to be mindful of that when we're looking to shop, right? I'm not saying that this area is the most solid area of support. It's actually not, right? When you compare it with a trade like Square, right? This is a breakout retest. You can clearly see the retest zone, and it is recent retest zone, right? It's not like SoFi where the closest area is down here at 11, and we're kind of counting on support that was back here in 2021, but it's not the most solid. You guys get the idea, right? It's a very nice play. It's a hype. It's a momentum trade. I like the company, but you got to be a little bit careful on this one, right? So that being said, the expected move for the week is 14.09. Let's go shopping on Square and on SoFi and see if we can find anything below that expected move of 14.09. So we're going to be looking at the 14s or the 13.5s, right? As you can see, for 1 week, guys, look at the amount of premium there. 13 cents. This is almost 1%. So this is the more aggressive strike. The more conservative strike is the 13.5s, which is significantly, well, not significantly, but it is below the expected move. I mean, 13.5 from here, that will be a drop of SoFi on the week of about 9.5%. We know SoFi can drop 9.5% in a day. They literally did it just last week, right? But at least you're giving yourself a little bit of more margin of safety, right? And this is one of the reasons why as well, even though I can write a ton of contracts, I'm going in with 1 or 2 contracts at a time. Here, then some more here, then some more here. And I want to build a position. If SoFi chooses to consolidate a little bit more, I'll be building a position the whole time and then for some eventual rallies into 2025, right? So that's how I'm playing SoFi. So for me this week, you know, if you want to be conservative, it's the 13.5s. They're giving 0.5%. If you want to be a little bit more aggressive, 14, but leave yourself some buying power to DCA in the event it does come down there. You'll be able to DCA in future weeks at the 12.5s, the 12s, stuff like that, right? Same concept as what I'm doing with my own account when I only went in with 1 contract at 15, and I'll be looking to DCA more 13s, 12s, etc., right? So that is how I'm playing SoFi specifically, and that wraps up our top 5 options plays. Now, I do have a ton of bonus plays for you guys, but I'm going to be going through these quickly and not giving you guys as in-depth explanations, right? I like these plays, but some of these plays and the bonus plays are either, number 1, not quite ready yet, they're coming down close to a support, but they're not quite there yet, or number 2, they're a little bit more risky than some of the plays that I gave you guys in the top 5, right? That being said, let's jump into the bonus plays. I won't be giving you the expected moves. You guys can go through those on your own, but I'll just try to fire off as many ideas as possible. Number 1 is going to be BITX. Why do I like BITX? Simply because of the premium, but we do not need to play these too close, guys, right? So this is 2 times Bitcoin leverage product, and you want to be targeting support areas. So think down here, 45 down to about $41. This would be a very large margin of safety, 23, 25% that requires Bitcoin itself to drop 10, 12% in a week. Look at all the premium that we can find down here on the weekly contracts, right? I'll expand the chain. We don't need to play these aggressively, guys. Do not get, well, I mean, you're free to do what you want. It's your money, right? But do not get seduced by writing puts too close to the money because they provide fantastic premium. Look, you can get 2% in 1 week here, but the way that I play these is more conservative. I go all the way down here, 45 to 47. You can see you're getting 0.5%, which is the strategy rules, and you're giving yourself a very, very, very wide margin of safety. I've been playing these guys pretty much every single week for the last 2 months, and we always do very well. Have not been assigned once, right? BITX, we played the 45s last week. We got 1%, over 1% for them. And once again, this one was a trade that expired 100% worthless. So if Bitcoin has a down day and you can find this one red, you can find some very good premium down here in the mid 40s. So that is BITX. Trade number 2 is a similar trade. TSLL, this is 2 times leverage ETF on Tesla. Now, I know not a lot of people have the buying power to write short puts on Tesla up here at around the 360, 350 range. It's like $35,000 to write 1 contract. So what do I do instead? I choose to write the 2 times leverage ETF, which is very cheap. But that being said, are we going to get greedy and go super close to the money and risk getting assigned on a 2 times leverage ETF product? No, I'm going to be playing this one conservative as I play all of my things in a conservative fashion, right? Take a look, all you can find. And I played this one as well last week, guys. You saw it as well. TSLL, I got the 23 twos for 18 cents, and we did not get assigned. I wouldn't mind being assigned down there because that is synonymous with Tesla coming back down 360, 350. And I wouldn't mind nibbling some shares, but am I going to be going super heavy on them? No, guys, right? So take a look at the options chain. You'll see, I mean, look, you can get 0.5% all the way down here, guys, for like 21.20 strike, guys, 11 cents, 10 cents, even the $22 strike for about 10, 12 cents. That is the 0.5% rule. Even the same ones I had the last week, 23.20. That is a significant decline for Tesla, right? That would mean that we would have to come down on TSLL down to 22%. That would mean that Tesla as a whole has to give up all the Friday rally and come down a whole 10+%. Can it happen? Sure, it can definitely happen, but at least we're getting a very good price if it does happen, and we can run some super juicy covered calls thereafter. So that's trade number 2. Some other trades, they're not quite ready yet, but they can be ready in the next few weeks, so keep them on your watch list. Apple, classic breakout retest trade. Retest would be around the 235, 230 zone. If Apple has another red week, maybe the next 2 weeks, if we can find some premium down here, low 230s, For the breakout, retest, and a bounce, I'll be looking to play Apple down here, but it's just not quite ready yet. Microsoft, same concept. Microsoft is a very expensive trade. However, if you like this one, I think this is the easiest money in possibly all of big tech right now, because Microsoft's been sideways consolidation for a year of time, and all they've been doing is improving their fundamentals. Down here, guys, 410 down about 405. If we can find some premium down there, easy money every single time, even for longer dated options, 3, 4, 5, 6 weeks type of thing. If you can find some decent premium, 412 down to 405. I think it's such a beautiful area for Microsoft coming down into lower support. You usually get a ton of premium down there. It'll reduce your average cost to lower the 400. I love playing this one, and I play it all the time in my bigger account. Another idea is SMCI. SMCI has some great volatility, but you do not want to get greedy, right? SMCI, I've played this one almost every single week as well. You can see it right here. We went with the 27.5s. Whenever I'm playing volatile names, guys, I'm playing them very conservative, right? SMCI, I like this region down here, 28.50 down to about 23, as low as possible. SMCI has some great volatility on the chain. It does not mean you have to play this one super close and get greedy, right? No, we want to be playing it lower in the support range and getting a very wide margin of safety. Number 5 is going to be SOXL. Same concept. It's a 3 times leverage product on the semiconductor industry. So as a whole, do we want to be playing it super close? No. You can see that every time I play this one is 27 down to 24. Last week, we got a gift. Early on in the week, they came all the way down here, 27.50. Look where I wrote, guys. We wrote the 24 puts. Easy money. We got 15 cents, which is over 0.5%. 24 was all the way down here. I'll buy SOXL if you want to send it all the way down there. I will gladly take the shares and write some covered calls. This is literally a 2+ 3 year range almost on SOXL. So no need to play these super close, guys. I'm being conservative, 27 down to 24. Even some of the China names, Baba had record profits when they reported their quarterly earnings early on in November. Down here, guys, 80 down to 75. It's not quite ready yet, but if you get one more leg down, I love playing this lower range on the China trades. 80 down to 75 on Baba, I think is extremely easy in terms of a trade. Great support, great valuation, but China's just been out of favor. Some of the banks are coming closer as well. Charles Schwab. If Charles Schwab can make its way a little bit lower, I love this region, guys. 72 down to about $68. This little pocket right here would not be opposed to playing Charles Schwab. Bank of America, not too sure if they're going to pop or continue along a little bit of a decline. But if we come down, guys, Bank of America, 42 down to roughly $40. Wouldn't mind playing that location as well. Some of the banks are getting ready. Some of the solar plays, if you like solar plays, I like to play the volatility on these. If Enphase has a 5-6% drop, usually you can find some super juicy premium down here in the $60 range for Enphase. Super steal on this company. That would be the lower end of 2020. Now, solar is not in favor right now, but it will not be out of favor forever. So if there's some big volatility, 5-6% down, and you can write 10% lower than that, 57, 58, all the way down here, juicy trade setup, right? These are some of the more volatile, out of favor sectors. FSLR, same thing. Solid company, super solid valuation, but the sector's out of favor. If I can ever find FSLR down here, 165, 160, it is not quite ready yet, but if it does come down here, I keep this one on my watch list moving forward. And now, another one, Zscaler, some of the cybersecurity plays, some of them are not looking too bad either. Zscaler in this location, 175 down to about 170, not a bad location. Very, very large support area, but you want to be playing as close as possible to the 200 weekly EMA, 175 down to 165. This little pocket here, the lows of 2024, that's where I don't mind playing Zscaler. Some of the recovery plays like Nike. Nike's just been an absolute disaster. But if Nike is a recovery story play for you and you want to play some premium, I would not be opposed. If Nike has some bad days ahead of it down here, and you can find the 70 flush zone area, 70, 68 on Nike, I think is a very juicy buying opportunity. If you have a long duration horizon on them and you just want to play a little bit of that volatility, it's the lows of the month of August. If you get a 67, 70 flush, daily oversold conditions, I wouldn't mind playing Nike down there as part of the wheel strategy. And lastly, you can even find some good deals in defense companies right now, such as Honeywell, right? Honeywell, look at this. It's a nice monthly breakout retest, monthly uptrend breakout, retest, and possibly run. Not looking too bad. The valuation is pretty good. Very, very, very solid company that we're talking about right now, guys. Right? 220 down to about 215. Short puts in that area for the retest zone, prior resistance all year. Now we've climbed ahead of it. Retest down there, you see they're establishing. They've been establishing for 5, 6, 7 weeks at this point. A little bit more of a push. I can get some shares down there and go for the trend continuation, right? After a 3+ month year range, I'll be looking for the breakout there. So that is everything that I had for you guys today. All the top 5 options plays, all the bonus plays. I must have thrown at you guys 25 tickers. So there should be some ideas for everybody. If you enjoyed this video, consider dropping a like. Would appreciate it for the growth of the channel. Also consider subscribing if you're new, guys. We're well on our way to 5,000 subscribers. Hopefully we can hit that in the month of January. And lastly, if you have any questions on the strategy, always feel free to leave them down below in the comment section. I would love to answer you, usually within the first 24 hours. And if you guys want access to all of these trades, these are all the trades from the Discord since the inception of the Discord. All the green check marks are the wins, of course. So if you want access to all these trades in real time, the link to the Discord is down below in the description, where I give all of my trades, not only the put wheels strategy trades, but the call option trades, the leap trades, the share trades, the debit spreads, the credit spreads, everything in between. Well, you get access to all of those trades. We do private morning live streams Monday to Friday for about an hour or 2 each morning, where you can see me trade live and ask me all your questions. Of course, we also have private videos that we don't show on the YouTube channel as well for strategy, psychology, and all the rest. And you can ask me your questions on your stocks and options all throughout the day, and I answer very, very quickly. So if any of that interests you, the link to the Discord is down below in the description. Hope to see you in there soon. And if not, I guess I'll see you back on the channel, guys. Take care. That's it for me. Have a good week in the markets. I'll see you tomorrow, and peace.